Today we're going to be talking about Capital One's acquisition of Discover Financial. All right. Welcome to Investment Banking Insights. This is the only show dedicated to helping you learn both the technical and non-technical aspects of the investment banking process. Hi, my name is Alex Mason and I am your host. I'm currently a second-year MBA student here at Cornell. Really excited to start working in investment banking here in a few months, but also enjoying these last few moments of school. And yeah, let's go ahead and talk about an acquisition because I think that deal pitches are really instructive. They help you think about how do acquisitions actually work, and they also help you understand some of the mechanics behind what investment bankers really need to know. Now, Capital One announced they were going to acquire Discover Financial Services back in February 2024. Now, that's a year ago as of this recording. The deal still hasn't closed yet. So it's an interesting case study to look at in order to better understand how do deals actually work. So let's talk about some basic facts about the deal. When the deal was announced, it was valued at about $35 billion in an all-stock transaction. Capital One was going to exchange just over one share of Capital One shares for every Discover share that they would get. So almost an even swap. And why would this deal happen? Well, Capital One, first off, in terms of its business model, they mainly make money through credit cards, through loans. They are a loan provider and they're essentially a bank. Now, Discover Financial Services is kind of interesting. They also have credit cards, they also issue loan products, but the interesting thing is they are also a network, a payment network. Now, in the United States, there are four major payment networks. You got Visa, MasterCard, American Express, and Discover. Now, Discover is the smallest of the four, but they still are a relatively large-sized business with over 70 million merchants. So it makes sense that Capital One would want to buy a company like this. It's a pretty big deal, but it's small enough where they could actually pull it off. So with every merger acquisition, we have to ask ourselves as investment bankers, why would this deal make sense? Why does the acquirer want this deal to happen? Why would the target want this deal to happen? Well, in the case of why the target would want the deal to happen, usually it has to do with, well, they want to get paid and they see that there's a big premium if they sell, right? So that's one of the big reasons. There could, of course, be other strategic reasons on the target side. But on the acquirer side, why does this deal make sense for Capital One? Well, frankly, they don't have a payment network. And now we live in a day and age where, in my opinion, financial services are becoming increasingly commoditized. Yeah, you have a lot of fintech and payment providers and a lot of smaller financial startups coming up, but a lot of those are actually getting swallowed up by the big guys and being integrated into part of these larger platforms. So you have these really large banks, these really large payment providers and networks that are dominating the entire financial landscape. So it makes sense for Capital One to say, hey, we have a certain amount of customers, we have a certain amount of growth, but we don't have this payments network. I said before that Capital One issues credit cards and they make money from loans on these credit cards as well as other types of products. Well, they don't actually own the network. They have to go through Visa, they have to go through MasterCard in order to help distribute these products and actually make it happen. So it's kind of part of this ecosystem. So they're saying, hey, we don't offer this network product. Why don't we buy a network and then integrate it into our current business? So that makes sense from an integration standpoint that Capital One wants to expand, but building a network from scratch is really, really hard, especially in the payments field. I mean, Visa and MasterCard, their origins started back several decades ago, back in, I think it was the 1950s, where they began creating a network across the United States and then eventually globally. It's really hard to do. There's a lot of technology as well as security related things involved with that. So Capital One said, you know what, we're just going to buy it. We're going to buy Discover out. So it's going to make Capital One a stronger competitor relative to some other banks because they now have this big network. And also remember that in a merger and acquisition, we have to consider what the synergies are going to be. Now, for many types of M&A deals, a lot of the synergies are going to come from the cost structure, right? We're going to be able to consolidate our sales teams. We're going to be able to reduce our capital expenditures. And those things are all usually true. But on the revenue generating side, that's where things can get really interesting if it actually works. Now, in the case of Capital One merging with Discover, you have a network effect, like a literal network effect happening, because now Capital One can cross-sell its products to Discover's customers and cross-sell Discover's customers over to Capital One products. So you have a lot of network effect potential through synergies there. Now let's talk about the consideration of the deal, the structure of the deal. Does it make sense? Why or why not? So the deal was valued at around $35 billion at the time of announcement. And I want to understand, does it really make sense for Capital One to issue equity versus debt, and why or why not? So I went into Capital One's financial statements and I started looking at the balance sheet, and I noticed that they have around $30 billion or so in what's just called other debt obligations. But really the bulk of their debt is about 10 times that, over $350 billion in deposits. So remember that a bank's assets are the loans that it gives out, and a bank's liabilities are the deposits that it holds. So banks pay us money when we put money in a checking or savings account, right? They pay interest on the money that we put in. That's why it's a liability. And on the asset side, if we borrow money from a bank, we're paying the bank interest, so it becomes an asset for them. Essentially, there's a whole lot of leverage in this business through just the deposits and the loans. And there is a decent amount of debt in terms of other types of debt, but it's not a massive amount to the point where I would necessarily be worried about the solvency of this business. So conceivably, Capital One could issue debt for this deal, but they don't really need to. And I think it's interesting because I think the textbook answer in an interview question is, what's more expensive, cost of equity or cost of debt? Well, cost of equity is going to be more expensive, so a lot of firms are going to borrow money, right, in order to make a deal happen. But Capital One isn't doing that. They're doing all stock. And if you look at the stock performance of Capital One, it's been generally pretty good. So over the past 5 years, Capital One stock price has gone up at about 100%. So it doubled in 5 years, which is a pretty good compounding rate if you ask me. So yeah, it kind of makes sense that they're using stock because they're able to sell at a higher price in order to acquire this business without burdening their balance sheet further. I also looked at the credit ratings for Capital One. S&P rates the credit rating of Capital One at a triple B, which is on the lower end of investment grade. It's still investment grade, but it's on the lower end. So it doesn't really make sense for Capital One to say, yeah, we're gonna borrow a bunch of billions of dollars in order to buy out Discover and potentially threaten that credit rating. Because once you go below investment grade, it's like debt starts to become way more expensive, and it just doesn't really make sense for shareholders. So those are really the reasons. Number one, Capital One doesn't necessarily want to risk having its credit rating go lower. And number two, their stock has been performing well. So with more expensive stock, it becomes more attractive to use that stock as currency to buy out another company, in this case, Discover Financial Services. So how did the market respond to this deal announcement? Well, Capital One was trading at about $137 per share before the announcement. After the announcement, stock didn't change that much. And then since then, it's been 1 year since the deal announcement. The stock is now over $200 per share. So the market is positive on Capital One, believes that they're going to do well in the future. And then if you look at Discover Financial Services, there was a little bit of a jump in price from about $110 per share before the announcement to $124 after the announcement. So immediately the market says like, okay, I like this deal. I think it's going to happen. But what's even more interesting to me is what has happened to Discover's stock price since then. So after a year, guess what? Discover stock price has gone up also to over $200. And in fact, on a percentage basis, Discover stock price has gone up higher than Capital One stock price has gone up. Now, let's think about this for a moment because this is an all-stock transaction. And that means that Capital One is giving up some money in order to get a higher stock price for Discover. And the thing is, this is like kind of interesting because the exchange ratio that Capital One is giving for Discover is about a 1-to-1 ratio. Not exactly 1-to-1, it's 1.0 something, but for all intents and purposes, about 1-to-1. So this means that Discover shareholders are technically getting a better deal now. Their stock price has gone up over 80% in the past year. So yeah, if you give me one share for one of my shares and my shares have gone up in value more than your shares, then I'm winning, right? Then I don't need to sell as many shares in order to get the same amount of your shares. So it's good for Discover. In practice, this might not hurt Capital One shareholders that much because of what's called a collar provision. This is a type of provision in M&A deals that helps protect both parties in the case that the stock prices of either party fluctuates a lot in all stock transactions. So if there's like a floor of a stock price that Capital One says like, hey, if the stock price of Discover goes below this amount, we need to renegotiate the exchange ratio. Conversely, if the stock price hits a ceiling above a certain amount, we need to renegotiate that exchange ratio. So that is the collar that helps protect shareholders when stock is being used as currency. So yeah, Discover shareholders might be benefiting more in theory, but I bet you in those provisions, there's something that the lawyers put in to make sure that the exchange ratios would be relatively equitable relative to the time that the deal announcement was made. So yeah, I think this is an interesting deal. It's certainly a big deal in the financial services industry. As of the time of recording this, it hasn't closed yet, but I do expect it to close unless there's some major regulatory reason it does not. It'll really give Capital One a big foothold in the payment network industry and immediately launch it into the top 4. And so we'll see how it responds and if Visa and MasterCard are affected or if Amex is affected much because of it. So interesting deal, one that I think if you're going into financial, like fintech banking or your financial and insurance group type of a group in investment banking is an interesting one for you to follow that you can use as you're thinking about interview prep. Okay, that's what I got for you today. My name is Alex Mason, your host here at Investment Banking Insights. I'm so grateful that you're here. Thank you for watching on YouTube. Thank you for listening on Spotify, Apple, wherever you get your podcasts. And I'd love to connect with you. You can connect with me on LinkedIn. You can leave a comment right here on YouTube, and I'll definitely see that. So thank you so much, and I'll see you on the next one.